You don't lose trades because you're dumb. You lose because you're overwhelmed by noise. You're bombarded with too many opinions, signals, and voices telling you what to do. Yet none of them prepare you for who you become when the market turns against you. But in 1957, a man named Nicolas Darvas, with no screens, no live news, and no Wall Street access, found a way to win. He did it quietly and methodically, all while working as a professional dancer. Section 1. The Ballroom Millionaire. Nicolas Darvas was a professional ballroom dancer and a Hungarian refugee who, in the 1950s, reportedly turned $36,000 into over $2 million in just 18 months. His success wasn't due to technology or insider tips, but to his emotional distance from the market and a systematic approach. His trading journey began in 1952 when he was paid in stock that unexpectedly jumped in value, sparking his interest. After initial losses from following popular advice and trusting brokers, he developed his own system. He noticed that stocks would often move in predictable boxes, a sideways trading range, before breaking out on high volume. His strategy was simple: recognize the box, wait for a high-volume breakout, and enter the trade. Darvas operated with minimal information, receiving delayed price quotes via telegram. He was disciplined, following his rules like choreography and ignoring distractions. He understood that the real battle in trading isn't against the market, but against one's own impulses. His low-tech, high-discipline method remains relevant today as a powerful reminder that in a world of constant noise, the real edge lies in less information, deliberate action, and patience. Section 2. Why 95% of traders stay stuck. Traders often fail because they are overwhelmed by too much information or noise, not because they lack intelligence. Nicolas Darvas, a ballroom dancer in the 1950s, succeeded by using a simple, disciplined approach while being physically distant from the market. His strategy, the Darvas Box, was based on a simple principle. Identify a stock making a new high, wait for it to trade within a narrow box or range, and buy when it breaks out with high volume. He would exit if the price fell below the box. This straightforward system eliminated emotional decisions and the need for constant information. The main takeaway from Darvas's method is that success comes from discipline and managing your relationship with market noise, rather than seeking more data. His approach shows the power of making fewer, better decisions based on a clear, systematic plan. Section 3. The Birth of the Box. How a dancer discovered. Traders often fail not because they lack intelligence, but because they are overwhelmed by too much information or noise. In contrast, Nicolas Darvas, a ballroom dancer in the 1950s, succeeded by adopting a simple, disciplined approach while being physically distant from the market. His career forced him to rely on minimal, delayed information, which became his advantage by preventing impulsive, real-time decisions. This unique situation taught him that simplicity often beats complexity in trading. His strategy, known as the Darvas Box, was based on a straightforward principle. Identify a stock making a new high, wait for it to trade within a narrow box or range, and buy when it breaks out with high volume. He would exit if the price fell below the box. This simple system eliminated emotional decisions and the need for constant monitoring. The main lesson from Darvas is that success comes from discipline and managing your relationship with market noise. His method shows the power of making fewer, better decisions based on a clear, systematic plan, rather than seeking more data. Section 4. Inside the box, the math behind momentum. The Darvas Box method provides a systematic approach to trading based on the rhythm of market movements. Expansion followed by contraction. Key mechanics of the Darvas Box. Box boundaries. A box is formed when a stock at a new 52-week high consolidates. The box top is defined by the new high, confirmed when the next 3 days fail to exceed it. The box bottom is the lowest point in that range, confirmed when the next 3 consecutive lows stay above it. Measuring risk. The height of the box, top, bottom, is used to calculate risk. This allows a trader to precisely size their position to match their risk tolerance, moving from guesswork to a mathematical approach. Breakout criteria. Darvas only entered a trade when the stock closed above the top of the box on significantly higher than average volume. High volume indicates genuine conviction and institutional interest, reducing the chance of a false breakout. Stop loss setup. A stop loss is placed just below the box's bottom. This defines the maximum potential loss from the outset, removing emotional decision-making. Trailing stops. As the stock's price rises and new boxes form, Darvas would adjust his stop loss to the bottom of the new box. This staircase method allows a trader to protect profits and stay in a trend for longer. The core principle of this method is to identify when a stock is consolidating the coiled spring and then act on a confirmed breakout. This systematic, rule-based approach helps a trader manage risk and avoid emotional decisions. The method isn't about being right every time, but about managing risk effectively when wrong. Section 5. Stacking profits like stairs. The art of the trailing stop. Once a trade is entered using the Darvas Box method, the most important question isn't when to take profits, but how to manage a winning position. Nicolas Darvas didn't use fixed profit targets. Instead, he let the market dictate his exit by using a trailing stop based on the formation of new boxes. How the trailing stop works. Entry and consolidation. A trader enters a position when a stock breaks out of its initial box, box number 1. As the stock rises, it may consolidate again, forming a new, higher range box number 2. Adjusting the stop. Once box number 2 is confirmed, the trader raises their stop loss from below box number 1 to just below the bottom of box number 2. The staircase effect. This process is repeated as new boxes form, creating a staircase of rising stops. This approach aims to achieve 2 key goals: letting profits run. It keeps the trader in a trend for longer periods. Protecting gains. It locks in a portion of the profits by raising the stop loss with each new box. This system is designed to remove emotional interference from exit decisions. Instead of guessing when a trend will end, the trader allows the market structure to guide them. While this method can be psychologically challenging, as it requires a trader to resist the urge to take profits early, it encourages discipline and a systematic approach to trade management. It shifts the mindset from prediction to a rule-based reaction, highlighting that true trading success often comes from managing the trade after entry, not just making the right entry. Section 6. When to enter, when to run. Volume as the secret gatekeeper. In the Darvas Box method, volume is the secret gatekeeper that separates meaningful breakouts from false signals. While price shows what is happening, volume indicates the significance of that movement. Nicolas Darvas reportedly never entered a trade without a clear volume confirmation. believing that discipline and waiting for the right signal was more important than trading frequently. The volume principle. The rule is simple. Only buy when a stock breaks out with significantly higher volume than its recent average. This volume surge often indicates the participation of large institutional players, whose buying activity creates a footprint that signals genuine conviction. The author outlines 3 types of breakouts to observe. Low volume, a potential false breakout that often reverses quickly. Darvas would avoid these. Medium volume, an uncertain signal that requires careful observation. High volume, the preferred entry signal, suggesting strong interest and a higher probability of a sustained move. While modern markets have changed with high-frequency trading, the principle remains relevant. A significant volume surge at a breakout still often indicates genuine interest and can be a reliable filter. The combination of a price breakout with a volume surge is key, as one without the other is a weaker signal. The core lesson from this section is to prioritize evidence over speculation. Before entering a trade, a trader should confirm a new high, a clear box, a price close above the box top, and a notable increase in volume. If any of these criteria are not met, the most prudent action is to wait. This systematic approach rewards patience over impulsiveness. Section 7. Ghost Boxes and Modern Hacks. Evolving Darvas for today. Although trading has changed since the 1950s, the core principles of the Darvas Box method are still relevant with modern adaptations. One such adaptation is the Ghost Box, a solution for managing trades when fast-moving stocks don't form clear consolidation patterns. Ghost boxes are projected ranges based on the previous box's size, allowing traders to use a consistent, systematic approach for trailing stops and staying in strong trends. The main lesson is to prioritize a flexible, disciplined plan over emotional decisions, with price action as the primary signal and other indicators as supplementary tools. Section 8. The Power of Distance. Nicolas Darvas, a professional ballroom dancer and successful trader, found that being far from a market was key to his success, not a hindrance. His trading career in the 1950s was defined by a lack of real-time information, forcing him to rely on delayed telegrams and newspapers. This distance became a crucial advantage, as it prevented him from making impulsive, emotional decisions based on short-term price fluctuations. Research shows that constant market monitoring often leads to overtrading, emotional reactions, and reduced performance. This is because our psychology is wired to react to perceived threats, which can be triggered by every price tick. Darvas's physical distance from the market created a form of forced discipline, allowing his systematic trading plan to work without interference. A key lesson from his story is the information paradox. More information doesn't necessarily lead to better decisions. It often creates more noise and can lead to worse outcomes. Darvas himself experienced this firsthand, reporting significant losses after returning to New York and immersing himself in the constant market buzz. He found that stepping back and consciously choosing to limit information flow led to improved results. For modern traders, this means intentionally creating emotional distance by setting specific trading hours, using price alerts, and avoiding constant screen time to achieve better clarity and discipline. Section 9. Why most traders fail. Discipline is not always the solution. Instead of relying on willpower and constant discipline, which can lead to burnout and emotional errors. Nicolas Darvas succeeded by building a systematic trading structure. His experience showed that more information and constant monitoring can overwhelm a trader, leading them to break their own rules. Darvas's method automated discipline through a simple set of rules: clear entry and exit criteria, limited decision points, and distance from market noise, which reduced mental fatigue and minimized emotional interference. The key takeaway is that sustainable success stems from a proactive, structure-based approach, rather than a reactive, willpower-based one. Section 10. Your path forward. The journey through Nicolas Darvas' story reveals that trading success is not about complexity, but about clarity and a systematic approach. His method, which turned $36,000 into millions, was based on core, timeless principles, focusing on a few key filters, building a structure to guide decisions, and strictly managing risk. The Darvas Box is more than a technical tool. It is a framework for systematic thinking, transforming market chaos into a structured process. The core lesson is that independence from emotion and randomness comes from having a robust system. The question for a systematic trader is not, what will the markets do, but what does my system indicate? To apply this, the text proposes a 30-day learning challenge. Study charts and identify stocks at 52-week highs. Observe and document the formation of boxes or consolidation patterns. Track breakout behaviors and their relationship with volume. Journal all observations without risking any money. This practice is designed to build a deep understanding of market patterns and systematic decision-making. The goal is not to perfectly replicate Darvas's historical success, but to learn from his principles and discover one's own systematic approach. Ultimately, success in trading is about preparation, discipline, and wise risk management, not about finding magic formulas.